Hey everybody, my name is Kyle Knott, and I am not your average finance guy. Let's talk a little bit about the term behind me there, buy term and invest the rest. Who says that? So some retirement planners will use that term, buy term and invest the rest. Dave Ramsey uses it quite a bit. That's one of his taglines. Um, One thing I want you to ask those people that say that is, do they get paid from whole life insurance? Dave Ramsey pushes term insurance because he makes money off of term insurance. That's a very lucrative way to make money. Insurance agents make a lot of money off of term. Why? Because I think I heard somewhere like 99, 98 point some odd percent, little over 1% of people actually ever collect on term life insurance. So that is a great deal for the insurance company because they collect premiums for a term of 10, 20, 30 years, and then all of that money they get to keep. So it's very good for the insurance companies. It's very good for the insurance agents. They make a lot of money on it because the insurance company is fairly certain that you're not going to die in that term, so they get to keep all the money. So that's one reason why a lot of people push the buy term and invest the rest. So do they know anything about the whole life policies, about the infinite banking concept? I understand. I was in that same boat. Listen to Dave Ramsey. He says buy term, invest the rest, and that's exactly what I did. But if you can go to the whole life side of it, think about it, and go through the steps, like, wow, this could really work if you just stop with the taglines and think it through. And I'll go on the other side of it. Some insurance agents don't know much of anything about retirement plans or investments, so they only push insurance products. And yes, a lot of them are term insurance products, and a lot of them, unfortunately, are, in my opinion, are IULs. And another, again, IULs, I made a video. If you're looking at buying an IUL, they've got a lot of the same terminology, and they're sold the same as like an infinite banking policy, infinite banking concept. Just ask your agent what happens if there's 2 down years in a row in the market, 2 down market years, and you're in your 80s. Ask them what happens at that point, and if they tell you the truth, they will say that the whole thing will implode on itself, and you will end up losing your policy altogether. That I am fairly certain of. If that's what happens in your 80s or God forbid your 90s, the whole thing is going to implode and you're going to lose everything your whole life to make. So the infinite banking concept is a classic whole life insurance policy, and it is guaranteed. As long as you keep up with your premiums, it is guaranteed to pay when you die, not if you die within a certain window, not if the markets are up 7% every year from now for the end of time. Doesn't matter what the markets are, it's a guaranteed they will pay. So a lot of the retirement people, buy term and invest the rest. With the infinite banking policy, buy whole life and invest it. Okay? It's not insurance investment, it's insurance, borrow against that for your investment. You have both of them. So that's the beauty in it, that your cash value always compounds, it always grows, and you're not taking it out, you're only borrowing against it. Buy term, invest the rest it's basically a gamble, I think. At some point, when you're older, in whatever that term is, 10, 20, 30 years is very common. After that term, you're going to drop your life insurance. So I guess the reasoning behind that is, okay, in 30 years, I bought I'll be very honest, I bought a term life insurance policy when my firstborn was born. And it's like, okay, I got a 20-year policy. It's like, okay, by the time he's 20, and by that time, I thought my investments would be so much that they'd be able to take care of everything and everybody. He is 15 now, and boy, was I wrong. I got a lot of work to do here in 5 years to make that happen. So what I did was I switched that over to a whole life and infinite banking policy. And since then, I've been borrowing against that policy and buying real estate. I buy cash flowing real estate. I take all that money, and you do take a loan against your policy. I'm not going to deny that. Take a loan against my policy, buy cash flowing asset. Cash flowing asset spins off cash flow. You take all that cash flow and you repay your policy. Once your policy is repaid, go ahead and do that again. Now you've got two sources of cash flow machines that are rolling back in, paying that off even quicker. Once it's paid off, go grab number 3. Spin it up till that's paid off even quicker, so on and so forth. And before you know it, you're paying these things back super quick, and you're just buying asset after asset, and you just keep on rolling with that. With a whole life, you're guaranteed to pay out. If and when I die, I'm probably gonna die. I get that. I don't know when. Hopefully it's way down the road, but at some point I will die. And I know that, and the insurance company knows that, and they take my premiums every year and they invest it, and that cash value that I put in there just continues to grow and grow and grow, and I can always borrow against that as long as I pay it back. And at some point when I do die, my beneficiaries, my family, will get the death benefit and whatever minus whatever loans I've still got out. So say I've got a loan out for a rental property. At that point, then that's just if it's $50,000 and they were supposed to get $3 million, they're only going to get $3 million minus $50,000 as a death benefit. And guess what? Then they don't have to pay that loan back because it's just taken out your death benefit. They'll still have the real estate. They'll still have the cash flow machine. Will still be printing money and still be sending money to their. So they'll have the cash flow of all my assets that I've built up through my lifetime. They'll also have a nice death benefit after that they can, hopefully they go buy more assets and they keep this machine going. That's kind of my goal here. We'll see if that happens. So the way my IBC policy is set up is I've got what's called a 10 pay. So I put $30,000 in the first year. I'm going to do $20,000 every year for 9 more years after that. At that point, I can wish to be done if I want to be. So the way that everything will work out when I pay those 10 years of premiums, I don't have to pay anything else other than that. If at that point I want to stop, that's $210,000 that I will have put into this insurance product. And I think I started this when I was 36 or 7 years old. So I've got a couple more years to pay on it. I'm 46 right now, so almost done if I want to be, and I could literally be done. And if I die within that, say I put all 210, as soon as I put the 210 in and I die the next day, my death benefit will be $735,000. That's on the low end. And from there, if I stop paying that moment, and that's all I ever put into it, and I live out to the ripe old age, I forgot what I looked it up, but what the number was, but it was somewhere in my 90s. If and when I die, and hopefully it's in my 90s, my family will get almost a $9 million death benefit, and I still only put in $210,000. So, what kind of return is that? Show me the stock that you're gonna pick that's gonna make that kind of return. So, and like I said too, I can use available cash value my entire life. I have access to some of this death benefit my entire life to buy assets and get this cash flow machine rolling. And hopefully you can get that. I'm teaching my kids how to keep this going, and hopefully they can do this with their families, and it can just go on for forever, perpetuity to whoever wants to enjoy these kind of perks. So that's the kind of stuff that I'm teaching my family that I'm hoping to teach my YouTube whoever would like to view. So if you got any questions, please let me know. I'd be happy to help. And good luck, everybody.